All right, welcome to today's explainer. Look, if you're constantly frustrated by getting trapped in those brutal retail liquidity runs, you are in exactly the right place. Consider this your personal blueprint for finally trading alongside smart money instead of against it. I'm going to step in as your mentor today, and we're going to walk step by step through mastering the ICT Silver Bullet strategy. We're going to break down exactly how to read those hidden institutional footprints left behind on your charts. So let's just dive right in.
So here's our game plan for today. We're starting off with the strict time windows you absolutely have to observe to avoid getting chopped up in all that retail noise. From there, we'll cover how to identify liquidity sweeps, confirm market structure shifts, nail down that sniper entry, and finally, and most importantly, how to protect your capital.
Okay, moving into rule number 1, precision timing and filtering out the noise. As a student of the market, the absolute first thing you have to control is when you are actually sitting at your charts. Notice these super specific 1-hour windows? We've got the London kill zone between 3 and 4 a.m. Eastern, and the New York kill zone from 10 to 11 a.m. Eastern. Why these exact times? Because this is when institutional volume literally peaks. You have to restrict your trading exclusively to these zones. Seriously, trading outside of them? That drastically increases your chances of getting caught in just random, low-probability chop. And this brings us to a quote that gets right to the core of ICT theory. When you trade is as important as where you trade. I really want you to burn this concept into your brain. High probability setups are completely dependent on moving in sync with smart money during those peak times. If the time isn't right, the setup just isn't right. Period.
Right, so now that we know exactly when we should be looking to trade, let's identify the trap that catches, honestly, like 90% of retail traders.
We need to find where the market is sweeping liquidity. So, what does a sweep actually look like? Well, it's when a single candle body, or even just a wick, clears the liquidity resting above or below a previous structural level, and then just sharply reverses. It's the ultimate pump fake. It's that classic retail trap where smart money collects a massive pool of stop-loss orders before aggressively reversing the market. Remember, they need your stops to fuel their massive positions.
Now listen closely here, because this is exactly how you avoid getting trapped yourself. A valid sweep absolutely must make sense on your higher time frame chart. We're talking about a 1-hour or daily zone here. You want to see a major higher time frame level get swept right during our 1-hour kill zone before you even think about zooming into that 1-minute chart for your entry.
Okay, so once that higher time frame trap is set and sprung, we drop down to the lower time frame to hunt for our trigger. We are looking for a true change in the market's internal order flow, and you have to spot the stark difference between a real structural break and a fake-out. A true market structure shift requires a full-bodied candlestick close beyond a swing high or low, and it needs to have aggressive momentum behind it. A liquidity grab? That's just a brief, sharp dash past a level that leaves only a wick behind. Please, don't let a temporary wick trick you into a bad trade. We need that full-bodied close to confirm a genuine change in direction.
And you know what the engine is behind that full-bodied close? It's displacement. Displacement is this sudden, super aggressive price movement characterized by long, wide-range candles with minimal wicks. Simply put, if there is no displacement, there is no structure shift. You absolutely must see these forceful, undeniable momentum candles to confirm that smart money has actually entered the market with real conviction.
So how do all these concepts build our institutional footprints? Well, these are the specific visual clues you need to look for that validate a true shift. You want to see that impulsive displacement. You want the full-bodied break. And crucially, this is the big one. It must leave behind a fair value gap while challenging the current trend.
The fair value gap is basically your golden ticket here. I want you to visually scan your charts for this exact 3-candle formation. It reveals a massive market imbalance where the price moves so incredibly fast that a literal gap exists between the first candle's wick and the third candle's wick. This gap, it acts like a giant magnet for price to eventually return to, and it completely validates your entire setup.
Now, alongside that fair value gap, we're looking for order blocks and breakers. These are your heavy-duty institutional support levels. For the silver bullet strategy specifically, pay special attention to the order block. It is the specific candle right before the aggressive displacement and FVG even started. It's the exact literal origin point of the institutional accumulation.
All right, so think about what we've got so far. We have our specific time window, we have our liquidity sweep, and we have our confirmed shift. Now let's talk about pinpointing that optimal entry. This is where we bring in the Fibonacci tool as our blueprint. What you do is map the fib from the very start of that aggressive displacement move all the way to the end of it. And then you just exercise some patience. You wait for price to naturally retrace back into your target zone.
And what exactly is that target zone? It is the 61.8 to 78.6% Fibonacci retracement pocket. This specific mathematical window is your optimal trade entry zone. Pulling the trigger here aligns you perfectly with the new directional bias, all while giving you a surgical, super high probability entry point.
Want to dial that precision in even further? Look at how your fib levels line up with your institutional footprints. To absolutely maximize your chances of getting filled, you want to place your limit order right at the mathematical midpoint where the fair value gap and the order block overlap. Let me tell you, that combined zone is incredibly respected by algorithmic trading models.
Okay, finally, let's talk about execution and stop placement. Because honestly, a mentor's primary job isn't just to help you make money, it's to protect your capital.
Before you even think about hitting buy or sell, you need to lock down these execution rules. Place your stop loss firmly outside the identified order block or just outside the first candle of that 3-candle FVG formation. And hey, always remember to add a small buffer to account for spread slippage. If your setup is valid, smart money is going to defend those levels. From there, you just target the opposing liquidity pools for your exit.
All right, you now have the complete silver bullet playbook in your hands. Let's say the market opens in an hour. Are you going to jump in and trade the chaotic noise, or are you going to be patient and wait for those clear institutional footprints? Take these strict rules to your charts, stay incredibly patient during those kill zones, and let the high probability setups come to you. You've totally got this. Keep analyzing, ruthlessly protect your capital, and I will catch you in the next explainer.